Imagine waking up tomorrow morning. Your bank account still exists, but nobody can prove how much money is actually inside it. Credit scores suddenly change overnight. Loan records begin disappearing. Banks freeze transactions. ATMs stop working. And for the first time in modern history, Wall Street realizes the entire financial system may have been built on numbers nobody can fully protect. Because the real danger was never hackers stealing money. The real danger begins when people stop trusting the system itself. And what happens next could change the global economy forever. Welcome to Currency Watch, a channel where we do not chase headlines, and we study the systems hiding behind them. And before we begin, if you are someone who still believes understanding money is more important than chasing trends, then take a moment to subscribe to the channel and tell us in the comments. Which city? And which country are you watching from today? For most Americans, the banking system feels permanent. People wake up every morning, check their phones, and see numbers sitting safely inside their accounts. Salaries arrive automatically. Credit cards work in seconds. Mortgage payments move quietly through digital systems nobody ever sees. Money flows from one screen to another so smoothly that most people never stop to ask a dangerous question. What actually holds this entire system together? Because modern banking no longer depends on physical cash the way it once did. The system now depends on information. Invisible digital records decide almost everything in modern financial life. A person's credit score can decide whether they buy a house, start a business, or even qualify for insurance. Loan databases determine who owes money and who owns assets. Banks trust computer systems to process trillions of dollars every single day without interruption. And that trust has become so normal that people rarely notice how fragile it may actually be. Inside office towers across New York, Chicago, and Washington, financial executives understand something the average citizen usually does not. The American banking system is not simply a collection of banks. It is a giant network of connected data. Every bank depends on payment processors. Payment processors depend on cloud servers. Credit agencies depend on centralized records. Trading firms depend on high-speed communication systems. Federal institutions depend on synchronized digital infrastructure. Everything is connected. And when systems become deeply connected, one disruption can travel faster than anyone expects. That is why cybersecurity experts no longer speak about cyber attacks as simple criminal activity. They speak about them as economic weapons. 20 years ago, wars targeted oil fields, factories, bridges, and ports. Modern conflict has started targeting something much more powerful: digital infrastructure. Over the past decade, hackers have already attacked pipelines, hospitals, transportation systems, and government networks. In some cases, entire organizations stopped functioning within hours. Fuel distribution froze, emergency systems failed, sensitive records disappeared, but financial systems represent a completely different level of danger. Because modern economies do not survive on cash alone. They survive on confidence, and confidence is built on one thing above all else: trust in the numbers. The average person believes the money inside their bank account is secure because the screen says it is there. Investors trust markets because transaction records appear accurate. Banks lend money because credit histories appear reliable. But what happens when the records themselves become uncertain? That question has started becoming more serious inside cybersecurity circles. Some experts now warn that future cyber attacks may not focus primarily on stealing money. Instead, they may focus on damaging trust itself. That changes everything. Imagine millions of Americans waking up one morning to discover strange activity across the financial system. Credit scores suddenly changing, loan balances disappearing, mortgage histories becoming corrupted, payment systems freezing without explanation. At first, many people might celebrate. Someone with heavy debt could suddenly believe they became financially free overnight. A person with poor credit might suddenly see an excellent score appear on their report. Social media would explode with excitement, confusion, and rumors. But inside financial institutions, panic would begin almost immediately, because banks would no longer know which records were real. And when banks lose certainty, lending slows down. When lending slows down, businesses lose access to capital. When businesses lose capital, hiring weakens. And once fear enters the system, economic damage can spread faster than the technical attack itself. That is the hidden weakness of modern banking. The system appears powerful from the outside because people only see the surface. They see skyscrapers, stock markets, and trillion-dollar institutions. But underneath all of it sits something surprisingly delicate: digital trust. Most people never think about how much of their financial life exists only as data stored somewhere far away. Their savings, debts, investments, retirement accounts, and credit history are all tied to databases they will never see with their own eyes. And those databases are protected by systems built by humans, which means they are not perfect. This is why governments and financial institutions now spend billions of dollars every year on cybersecurity defense. They understand that the real danger is no longer only physical attack. A modern cyber attack can create economic fear without destroying a single building. Because if people stop trusting financial records, then every relationship inside the economy becomes unstable. Depositors question banks, banks question borrowers, markets question liquidity, and governments begin fighting to stop panic before panic becomes collapse. That may be the most important lesson of all. The greatest threat to the American banking system may not be a lack of money. It may be the possibility that one day, people stop believing the system truly knows where the money is. At 6:12 in the morning, the first signs appeared quietly. A small business owner in Ohio opened his banking app before work and noticed something strange. His company loan balance showed $0 owed. At first, he believed it was a technical error. Then he refreshed the screen. The balance was still gone. Minutes later, a teacher in Arizona checked her credit report and suddenly saw a perfect credit score. A college graduate buried in student debt discovered that years of loan history had vanished overnight. Across social media, screenshots began spreading faster than explanations. Some people celebrated, others laughed. Many believed the banking system had made a mistake that would be corrected within hours. But inside financial institutions, the atmosphere was completely different. Because while ordinary citizens saw financial freedom, cybersecurity teams saw something far more dangerous: a synchronized failure of trust. Deep inside secure operation centers, analysts started noticing irregularities spreading across multiple systems at the same time. Payment records no longer matched settlement records. Credit bureau databases showed conflicting information. Loan verification systems began producing corrupted outputs. No one yet understood the full scale of the problem. But executives already understood one terrifying fact. The attack was not targeting money directly, it was targeting confidence in the data itself. And confidence was the foundation holding the entire banking system together. By mid-morning, emergency calls began moving between major banks, federal regulators, payment processors, and cybersecurity agencies. Trading desks stayed operational, but fear quietly entered every conversation. Because modern banking depends on synchronized information, a single incorrect number can create confusion. Millions of incorrect numbers can create paralysis. Inside New York financial offices, executives faced a nightmare scenario they had discussed privately for years, but hoped would never become reality. They could no longer fully verify the accuracy of their own records. And once verification becomes uncertain, every financial decision becomes dangerous. Should banks continue approving loans if credit histories might be corrupted? Should investors trust balance sheets if transaction data may have been manipulated? Should payment systems continue operating if settlement records no longer match? The problem moved beyond cybersecurity. It became a psychological crisis. Across America, ordinary people still did not fully understand what was happening. News stations reported technical disruptions, while experts tried avoiding public panic. But social media had already started creating its own narrative. Some called it digital liberation. Some believed hackers had finally reset the system. Others claimed banks were hiding the truth. And that confusion itself became part of the danger, because modern economies do not collapse only from technical failures. They collapse when uncertainty spreads faster than information. By afternoon, small cracks began appearing in consumer behavior. People rushed to ATMs, online banking traffic exploded, customer support lines became overloaded within minutes. In several cities, local businesses started reporting delayed payment processing. Restaurants could not verify transactions. Payroll systems froze unexpectedly. Wire transfers stalled inside verification queues. None of these problems alone could collapse the economy. But together, they created something much more dangerous: loss of confidence. And confidence behaves like oxygen inside financial systems. Most people never notice it until it begins disappearing. Inside government offices, officials debated whether the public should be told the full truth. Some feared transparency would trigger panic. Others feared silence would create even greater chaos later. Meanwhile, cybersecurity investigators discovered another disturbing possibility. The attack may not have been designed to permanently destroy the system. It may have been designed simply to make people question whether the system could ever be trusted again. That distinction changed everything. Because stolen money can eventually be replaced. Servers can be rebuilt. Software can be repaired. But once public trust breaks, recovery becomes far more difficult. History had already shown this pattern many times before. Bank runs rarely begin because cash physically disappears first. They begin because fear spreads first. People panic when they believe others are about to panic. And in the digital age, fear now travels at the speed of algorithms. One viral screenshot can reach millions before institutions release a single official statement. One rumor can pressure markets before facts are confirmed. One uncertainty can trigger billions of dollars in defensive behavior. That is why the modern financial system may be more psychologically fragile than previous generations realize. The entire structure depends on people continuing to believe the system remains stable tomorrow. By evening, emergency meetings intensified across Washington. Federal agencies discussed liquidity support, banking executives prepared contingency plans, cybersecurity firms worked without sleep trying to isolate the source of corruption. But underneath all the technical discussions sat a deeper fear nobody wanted to say publicly. If digital trust could be shaken this easily, then maybe the system had always been weaker than it appeared. And somewhere behind encrypted networks and anonymous screens, the attackers may have already understood something Wall Street spent decades trying to ignore. Modern banking does not survive on money alone. It survives on belief. The most dangerous phase did not begin with collapsing banks. It began when ordinary people started changing their behavior. On the second morning after the cyber attack, America still looked normal from the outside. Traffic moved through major cities. Coffee shops opened. Markets prepared to trade. Office workers carried laptops into glass towers exactly as they had the day before. But underneath the surface, something invisible had started breaking. People no longer fully trusted the system they depended on. And once trust weakens, behavior changes faster than governments can control. A restaurant owner in Texas refused to accept certain digital payments because transaction confirmations kept failing. A supplier in California demanded cash before shipping inventory. Small businesses delayed employee bonuses because payroll systems could not verify account balances correctly. Every decision looked small on its own, but together they created the early signs of economic contraction. Inside the financial world, executives understood what the public still did not. The attack had exposed a terrifying weakness inside modern banking. Most money no longer exists physically. It exists as digital agreement, numbers on screens, entries inside databases, signals moving between institutions that trust each other to maintain accurate records. That trust had powered the American economy for decades. But now, millions of people were starting to question whether the numbers in front of them actually represented reality. And that question alone had the power to slow the entire system. At major banks, emergency verification teams worked around the clock trying to compare damaged records with backup systems. But the deeper investigators looked, the more uncertainty they found. Some payment histories conflicted with archived records. Some credit reports showed impossible changes. Some loan ownership files no longer matched internal ledgers. The problem was no longer only technical. It became philosophical. How does a financial system function when nobody fully agrees on which numbers are correct? That fear spread quickly through financial markets. Large investors began moving capital into assets they believed felt more real. When gold prices surged, treasury demand increased temporarily. Some wealthy individuals quietly transferred money into foreign accounts. Others began buying physical assets instead of holding digital liquidity. This behavior revealed something uncomfortable about modern finance. During periods of uncertainty, people instinctively search for things they can physically understand, because digital wealth feels stable only when systems appear trustworthy, and now the system looked vulnerable. Meanwhile, media coverage became more chaotic with every passing hour. Some networks minimized the situation to avoid panic. Others exaggerated collapse scenarios for attention. Online influencers flooded social media with conspiracy theories. One claimed the attack was an inside job. Another insisted the banking system had secretly been unstable for years. Millions watched, shared, argued, and panicked in real time. Information itself became unstable. And when information becomes unstable during a financial crisis, fear multiplies faster. Inside Washington, pressure intensified on federal officials to restore confidence immediately. Emergency statements promised that banking infrastructure remained secure. Central authorities reassured citizens that deposits were protected, but many people no longer trusted official language. Because confidence cannot simply be ordered back into existence, it must be believed. That became the central crisis facing policymakers. The government could stabilize liquidity. Banks could repair servers. Cybersecurity firms could rebuild infrastructure, but none of them could instantly repair public psychology. And financial systems are deeply psychological systems. Every bank operates on the assumption that most depositors will remain calm. Markets operate on the assumption that investors will continue trusting valuation systems. Lending operates on the assumption that risk measurements remain reliable. When those assumptions weaken, even temporarily, the economy begins slowing itself down. By the third day, signs of that slowdown became impossible to ignore. Regional banks quietly tightened lending standards. Investment firms delayed financing deals. Several companies paused expansion projects due to uncertainty surrounding payment systems and credit verification. Fear had started affecting real economic activity. That is how modern financial crises evolve, not always through explosions or dramatic collapse, but through hesitation. A business delays hiring, a bank delays lending, a consumer delays spending, an investor delays expansion. And slowly, uncertainty transforms into economic paralysis. Late that evening, cybersecurity analysts uncovered another disturbing discovery. The attack may never have intended to permanently erase financial data. Instead, its real objective may have been much more strategic, to demonstrate that the system could be psychologically destabilized. That realization changed the conversation completely, because if a small group of attackers could create nationwide uncertainty merely by disrupting trust in digital records, then the future of economic warfare had already changed forever. No missiles, no invasions, no physical destruction, only uncertainty injected directly into the nervous system of the economy. And perhaps the most dangerous part was this: the attackers did not need to completely destroy the banking system. They only needed millions of people to imagine that it could collapse, because once enough people believe, a system may fail, they begin behaving differently, and behavior itself becomes the crisis. By the fourth day, the public still believed the crisis was mainly about hackers. Inside Wall Street, they understood it was becoming something far more dangerous. It was becoming a crisis of perception, and perception controls financial systems more than most people realize. Behind closed doors in Manhattan, emergency meetings continued without pause. Executives from major banks, hedge funds, payment companies, and federal agencies gathered around conference tables, staring at screens filled with risk models that no longer behave normally. For years, those institutions trusted algorithms to measure stability. Now the algorithms themselves were being questioned. One senior analyst reportedly summarized the fear in a single sentence: "If the data cannot be trusted, then the models cannot be trusted either." That sentence quietly captured the real threat facing the financial system. Because modern banking no longer runs on human judgment alone. It runs on automation. Loans are approved through automated systems. Fraud detection uses artificial intelligence. Creditworthiness is measured through algorithmic scoring. High-frequency trading systems move billions of dollars in milliseconds based on digital signals. The economy had become deeply dependent on machine trust, and now machine trust was under attack. Across the financial sector, institutions started doing something they almost never do during normal conditions. They slowed down voluntarily. Large banks quietly increased transaction verification times. Investment firms delayed settlement activity. Some lenders paused approvals for high-risk borrowers until internal databases could be audited again. To the public, these looked like technical delays. Inside the system, they were signs of defensive fear. Because when uncertainty enters financial networks, every institution begins protecting itself first. And when every institution becomes defensive at the same time, liquidity begins disappearing from the economy. That is when experts inside Washington started worrying about a second-stage crisis. Not the cyber attack itself, but the economic chain reaction following it. The American economy depends heavily on continuous movement. Businesses borrow to expand. Consumers spend through credit. Investors move capital through financial markets. Banks lend based on expected confidence in future repayment. But confidence had started weakening everywhere at once. And confidence is difficult to measure until it suddenly disappears. By now, social media had become a second battlefield. Videos claiming the banking collapse has already started gained millions of views overnight. Some users encouraged people to withdraw cash immediately. Others promoted rumors that certain banks were secretly insolvent. Most of the information was unverified. But financially, that almost did not matter anymore, because perception itself influences economic behavior. If enough people fear a bank may become unstable, they begin withdrawing money. If enough withdrawals happen quickly, even healthy institutions can face pressure. This is why governments fear panic more than technical damage. Panic spreads independently. Inside federal agencies, officials debated how much truth the public could emotionally handle. One side believed transparency would reduce conspiracy theories. Another feared honesty itself could accelerate instability. Every decision carried risk. If authorities appeared too calm, people would suspect they were hiding the truth. If authorities appeared too alarmed, markets could react violently. This created an invisible psychological war between reassurance and reality. Meanwhile, something unexpected started happening among ordinary Americans. For years, many people had quietly distrusted the financial system. Rising debt, inflation pressure, housing costs, and economic inequality had already weakened public confidence long before the cyber attack began. Now the attack amplified those frustrations. Some citizens openly celebrated the chaos online. They argued that banks had spent decades trapping people inside debt systems they could barely escape. Others questioned why their entire financial identity depended on databases controlled by institutions they would never truly understand. The cyber attack unintentionally exposed something much deeper than technological weakness. It exposed emotional resentment buried inside the economy itself. And that realization deeply worried policymakers, because systems become hardest to defend when large parts of the population stop emotionally identifying with them. Late that night, emergency reports reached federal leadership, warning that international markets were beginning to react. Foreign investors started questioning whether American financial infrastructure remained as secure as previously believed. That possibility carried enormous consequences. The United States dollar dominates global finance largely because the world trusts American systems, not only militarily, not only economically, but digitally. If that digital trust weakens globally, then geopolitical consequences begin expanding far beyond one cyber attack. That is when the crisis stopped looking temporary. Because leaders now faced a terrifying possibility, the attack may have exposed a structural weakness that could never be fully unseen again, even if systems recovered, technically. Even if records were repaired. Even if markets stabilized. One psychological change had already happened. Millions of people now understood that modern banking was not as untouchable as it once appeared. And once a society sees vulnerability inside the system controlling its money, that knowledge never completely disappears, because the real shock was never discovering that hackers existed. The real shock was realizing how much of modern civilization depends on invisible trust between strangers, and how quickly that trust can begin falling apart.